All right, we're live. We've got Chris Miles on with me today. He is kind of the guru on passive investing and passive cash flow. And, I thought it'd be great for everybody to kind of meet him and see what he's up to these days. If you don't know who Chris is, check out his website at moneyripples.com and kind of see what he's up to. So, Chris, why don't you introduce yourself to everybody and we'll kind of get into this.
Yeah. So you kind of said it. Now I'm the anti-financial advisor is really what I am, right? I started out 20 years ago being the mainstream financial advisor, AKA salesman in a suit, and showed up as that. I did that for several years, but I realized people weren't financially free. They weren't, including my own clients, right? And these are clients I inherited from other financial advisors from
Mhm.
decades of advice. They weren't financially free. And of course, when the student's ready, the teacher appears. I had a friend that was in real estate investing. His name was Doug. And Doug and I started this argument about what's better, stocks or real estate. And he finally just said, Chris, let me ask you a question. How many of your clients are actually financially free where they don't worry about money? I was
Mhm.
like, oh, dang it. I already know the answer to this. I'm like, well, they don't worry about money because I have retired clients, but they're worrying about it. I said, well, zero. I've got none of those clients. He said, great job. Way to help nobody. How about this? He's like, if anybody has this figured out, it should be you guys as financial advisors. So, how many of you are financially free, not off the commissions you're earning? That doesn't count, but actually investing in these mutual funds, right?
Mhm.
And I thought about it and I realized there was guys working in my office since the late 1970s. And as I'm thinking about these old guys that should be retired and they're still working in the office, I said, well, none of them are financially free. He said, and that's your problem. And I said, well, you better give me an answer here. Cause okay, well, now what? He's like, Chris, I'm not gonna give you an answer. You already got done telling me the stocks were better. I'm like, listen, like I'm open, give me something. He said, all right, fine. If you really are, and I don't think you are, but if you are, get this book by Robert Kiyosaki called Who Took My Money, which is a lesser known rich dad book to save you the 3 hours audiobook. Mutual funds suck. There you go. He just explains very much in detail why. And then he says, go listen to this radio show, this AM talk radio show that these local real estate investors were doing. And so I did. And after a few months, I had to make a key choice. Either I stay, keep in my career as a financial advisor, and especially when I was at the height of my practice, or stay in integrity and quit. So I quit. I vowed never to be a financial advisor again.
Yeah.
I was just going to teach ballroom dancing at the local university and be a mortgage broker. And that's what I did. I did that for some time, but I'll tell you, even after just a month, it was gnawing at me. I had to know what these guys knew. Like, how are they making these kind of returns in real estate? And as I started to see that expand, I realized, wait a minute, like this is not about accumulating money forever, saving everything, spending nothing, saving crappy mutual funds and 401ks and stuff like that. I could actually create real cash flow now with doing different things in real estate. It actually generate real passive income. And so later that year, I was actually able to retire myself just before I was 29 years old. Was figuring out what to do with my life. I actually came out of retirement to teach people how to get out of the rat race. And then I started gambling with my real estate. And so I went through the recession where I ended up going from millionaire to upside down millionaire, went over $1 million in the hole, was able to dig my way back out without bankruptcy, but I was able to dig out of that hole. And by the end of 2016, became financially independent for the second time, just to prove myself that it actually works.
Right.
And that's what I'm doing. That's what I teach people to do is really how to get out of the rat race, how to get you to work because you want to, not because you have to, right? And get your money out of prison, get it working for you. And we even do stuff like, what I call max ROI, infinite banking, and how to use that to double dip and all that kind of stuff. So that's really our focus is get people financially independent.
So do you I guess promote real estate as like your number one like investment vehicle, or do you use like are you kind of the way that I always view it and the way that I've done well is buying real estate and then taking the cash flow and reinvesting it into more real estate, or
Yeah.
in this case maybe it's whole life insurance, or it's whatever other investment vehicle that's out there. But I'm not sure, like, what have you seen people get the most success out of, or what have you gotten the most success out of?
Yeah, generally when we do alternative investments, so I'm anti stock market now, anti mutual funds. Unless we see the market crash 90%, I actually might put money in finally. But
Mhm.
I've been out of the market for years because it's been just too hot, too just
Yeah.
ridiculous and
Yeah.
unpredictable. And the only place you can really get predictable cash flow is in alternative investments like real estate investing. And real estate actually has a real tangible asset that holds value, where, even stocks, it's arbitrary. You never know. I mean, I just
Mhm.
talked to a guy today who lost a crap load of money because he said, I bought Tesla and then Tesla tanked. And he's like, yeah, I got hosed on that one.
Yeah.
Or, people that buy a bunch of crypto and stuff, and they think, oh, this is the next gold, but it doesn't hold its value, right? Like that's all the crazy stuff that's going on. But the one thing you can be certain of is that if you buy real assets that are profitable, like could be turnkey real estate, like we always focus on passive stuff. So not
Mhm.
so much the active flipping and things like that,
Right.
although you can do it, but that's an active investment or business that you're running. When we do passive stuff, it could be like turnkey real estate where you don't manage the properties, right? It could be, doing multifamily syndications or self-storage or commercial type stuff with syndications. It could be even oil and gas. So you can even go outside of it, but maybe more leasing the land
Mhm.
versus just drilling, so it's not so speculative. I even do things with raw land, where, I've got $100,000 now paying me over $5,000 a month with raw land investing and just seller financing and terms and things
Sure.
like that.
Yeah.
So
Yeah. True.
hard money lending, you can do so much
Yeah.
that you don't
Yeah.
need mutual funds. I mean, the stock market's averaged 8.24% for the last 30 years as of yesterday. I just went and calculated 8.24%. That's before fees come out, before taxes and everything. You can make so much more. You can make easily double-digit returns in real estate with less risk. So why not do that?
Yeah, no, I agree. I mean, personally, I've been the most successful financially with real estate. And then
Mhm.
it's kind of like we've kind of circled back now where myself being a fireman for 22 years, getting into real estate, becoming financially free, and then we've kind of like circled back to where we're trying to help other first responders, military, police, nurses. I mean, we work with physicians and other high income earners, but
Mhm.
also like your average person. I mean, if you're investing in syndications, we do a lot of 506B syndications, so
Yeah,
you don't have to be accredited in order to get into those. And
right.
that's a great avenue for a lot of, I would consider like your average person to, that maybe was somebody that has worked 20, 30 years, has a 401k or really a self-directed IRA is the one that we see people invest the most out of, but how they can use those funds that they've accumulated over the years and put it into an alternate investment vehicle. And a lot of them seem to do better than, you know, better faster than they were ever doing, keeping their money in the like you said, 401k, the stock market or whatnot. And the other part of I think that for me that I didn't like the stock market was, people always talk about paper losses and they act like it's no
Mhm.
big deal. But man, you're like if you were somebody that was buying GameStop when it was, when it was just going up and up and up, and you thought, man, this is gonna be great, and then
Mhm.
you know, you know you look back at it now and you see kind of like what was really going on then and why it stopped and who was truly affected. It wasn't the big hedge funds and the bigger groups. It was the average person that was kind of day trading and they're the ones that lost a ton of money. I mean,
Mhm.
and so that's just like one example that was more recent, but there's all kinds of examples like that. So um
Yeah. It's
you
there's a lot of dumb money and stuff that goes on in that, right? And it's funny because planning wise, because we do a lot of strategic planning with clients to help them, map out the way to get there and even connect with deals and whatnot.
Mhm.
And the thinking you have to always reverse is you got to get out of this accumulation mindset. The accumulation mindset says, hey, if I just grow a big enough nest egg, then I can live on less than the interest. And that's what you have to do with mutual funds because you don't know if it's going to go up or down. And even if you try to move your money out of the market into bonds and things like that, it's not returning a lot. And so it's fascinating because there used to be the whole 4% rule. Many people would say, okay, if I have $1 million saved up in my IRAs or 401ks, I can now live on 4% or 40,000 a year. Now, 15, 20 years ago, we were questioning that as financial advisors saying, is that too high? Will people still run out of money, especially if there's market swings and things like that? Because if you pull out money while you lose money at the same time, you won't recover. It's like people right now with inflation, right? And I expect the stock market to start correcting itself to start dropping. If it drops, say 25%, and at the same time inflation's 10%, that's like
Mhm.
disinvesting because you had 100,000 bucks. Now you need 110,000 next year to have the same quality of life, but you just lost down to 75,000 bucks. Good luck trying to get back there if it just keeps going up. The inflation is going up, and you're trying to chase it like a Dalmatian after a
Yeah.
fire truck. It just
Yeah.
doesn't work well. So you got to make sure that it's got to be reasonable. And so what we found out, and I was saying this before, I was saying don't pull out more than 2 or 3% from your retirement plans. Guess what? Wall Street Journal just came out last October, finally caught up to me, and they said 3%. They said 3% is our new number. You shouldn't go over 3% if you don't want to run out of money when you're retiring, and even less so if you're younger, right? So maybe even less than 3%. Well, do the math. If you happen to save up $1 million, now only at 3%, that's $30,000 a year, and you still have to pay taxes.
Right.
So now you're living on really maybe 24,000 a year, $2,000 a month. You are living in poverty as a millionaire. You're a broke millionaire. Where you and I already know, like passively, if we're doing like syndicated deals or whatever it might be, even if we get like 10%, and we know we can get a lot more than that, but even just 10%, well, guess what? Now we're not living on 24,000, $2,000 a month. Now we can live on 100,000 a year with that same $1 million. And that's the thing that's rocking people's worlds, right? Like even when I had, clients that recently, they said, hey, it's been a year and guess what? We're netting 280,000. Like we cashed out money out of our house. And now even after the mortgage payments, we still are making $280,000 more than what we pay, plus getting our money to work for us. I mean, they're literally work optional. Like they now just show up to their office as a chiropractor. They do it because they want to, because they love it, not because they have to.
Yeah. And that's a great position to be in, right? Is it you go to your career if you have a career that you love and you can do it now because you want to, and that money is just kind of extra like play money or vacation money or whatever you want it to be versus like what you're no longer living paycheck to paycheck. And I think that, for me, when I bought my first deal, like the thought of buying something over $1 million was just mind boggling to me that, it was this huge, like kind of untouchable figure pie in the sky number that, I would never get to because I was always thinking, how many hours would I have to work or how many years would I have to work in order to make that kind of number? And, for most people, it's just unfathomable, and like when we talk about, syndications, what we do, it's hard to, especially new investors, to really understand like how to quantify that and like how like it can just really, you take your $50,000 that you have in your self-directed IRA that you've held, that you've saved for 20 years or whatever it is, and and then you reinvest that. Like it's like they don't. I don't know. It's such a we'll have new investors and we'll have like several 2-hour conversations like explaining them from like the get-go of how this works, how you can do it, and like that it's actually a safe option because everybody's always told, especially in like the fire service for us in Ohio, we have something called the deferred comp plan, and it's basically similar to a 401k, but you're, every month, every 2 weeks, money goes out of your paycheck, you put it in there. It's a tax deferred account. And then at the end of retirement, it's, hey, it just adds to what you've got. But what guys they don't understand is that dollars put in there today are less valuable in 20 years or in 30 years or whenever they retire. And so, if you work a whole career and you're putting in $100 a pay or $200 a pay or whatever you can afford, what you put in over your whole career is what you're saying is that you get to the end. And that dollar amount that you've saved, you sacrifice that whole time. You could have been investing in something that kind of hedged against the appreciation. And your account might say X amount of dollars, but the taxes are usually higher. The cost of goods are usually higher. And so, they're going to take all of that, the tax stuff out before that you get a dime. And then, like you said, 3% is nothing in the grand scheme of things. And so I know that, like you said, hard money lending, like if people don't know what that is, I mean, they can get on our Facebook page and that's stuff that like we talk about, but that's, I have guys that I know that are doing hard money loans that are making 14 to 16% interest on their money. I mean, and that's not unheard of in real estate, and that, like I said, when you go to try to tell it to people that aren't in real estate or don't think that they can get into real estate and they think it's like, you're just making this up. Like there's no way that
too good to be true.
Yes. A lot.
Which is the same thing I told my friend Doug. When he said when he mentioned that him and his dad had done real estate in 5 months, they doubled his dad's income as a professor. I said, "Oh, come on, that's too good to be true. There's got to be some catch to this because remember, in the traditional world, we're taught high risk creates high returns, right?
Yeah.
First off, I want you to logically think about that phrase. The definition of risk is chance of loss. So if you have a 90% chance of losing, are they saying that you have a 90% chance of winning? Yeah, I mean. It's hard for me to do math, but 100 minus 90 equals 90. That doesn't make sense, right? It's not the case, but they've taught us that because the institutions, the banks, right? Like the Fidelities and your Goldman Sachs and Merrill Lynch's, they make guaranteed cash flow. They charge those fees out of your account, whether you make money or not. So they always get paid based on assets under management, right?
Yep.
Well, when they're doing that, think about it. They're the ones telling you to take high risk because they're not the ones putting their money at risk. They're letting you put your money at risk. You're the one gambling in the markets, not them. So when they tell you that kind of stuff, they're telling you that because they want you to take all the risk, when in truth, they know good business sense says, no, I want the lowest manageable risk possible to get the highest returns possible. I want to guarantee that I can always make more money. And so when you've been brainwashed your whole life to think that high risk creates high returns, you hear 14, 16%, you automatically think, oh, that's got to be risky. No way. And you and I know it because, I mean, sometimes you get those people, all you have to do is say, tell you what, for hard money, you can give me the money. I'll pay you 6% a year. I'll pay you 7% a year. And they're like, oh, great. That sounds awesome. Love it. Let's do it. You tell them 14 or 16%, they think, oh, hold on. Is this a Ponzi scheme?
Yeah.
It could be the same deal, but just those numbers, it can't fathom it. And so luckily my clients are they get educated to the point where they like to be rich. Right. But man, I always love those people when they're like, oh, no, that's too much. Okay, great. I'll make a spread on your money. I'm cool with that.
Yeah. I mean, you could, in theory, yeah, they could borrow you the money and you pay them a lower amount. And you just turn around and re-lend it out there for like a bank would and make
Yeah.
the difference. So,
yeah. I just go into debt to them and then I go and make the money.
Yeah. Yeah. And the other thing too, I guess I wanted to talk about is just the how you like, or your investors, like when they're looking at syndication. So for most people that are kind of like follow me or around me, I mean, that's what we do. We have a pretty sizable portfolio now that we manage and we oversee, and how are they, like, I guess if you have somebody that's looking to get into that or looking to get into some kind of passive investment, right? Because the whole point of doing a syndication as far as an investor is because it's passive, right? A lot of people that I talk to, they like, oh, I don't either. They have great careers and they love what they do, and so they don't want to get into like managing the rental. That's what everybody's fear is like, I don't want to be called at 3 a.m. for a leaky toilet or a furnace going out, or I don't want my holiday disrupted. And so I think a lot of people, they understand that real estate is a great investment vehicle, but they don't understand how to get into it and it not affect their lives or their career. And so when we started doing syndications, that's kind of like I said, it's kind of like the I don't know what you want to call it. There's a learning curve to it that we have to spend a lot of time with new investors. But we usually we do usually an 8% preferred return. We do an internal rate of return of about 15, or I'd say about 18 to 22% on average, but which is pretty standard. But I think that for me is like, what do you see investors that you're working with? Like, do you feel the same thing when you have somebody that comes into your program that's like learning about syndications for the first time, or like people that I don't know, I guess are you kind of like the intermediary between the investors and like the sponsors, where you're kind of, you said you're kind of vetting the people that are doing the deals, and then you're kind of taking it back to your group and saying, hey, look, here's a couple deals that you guys can put money into, and I vetted these guys through various different means, and these guys are legitimate, and then that's how that kind of works.
Right. Yeah, exactly. We're more strategists than connectors, right? So we help strategize and kind of help almost create like a planning type, consulting model. We're trying to figure out like what's the best way to deploy your money. More importantly, how do you get your money out of prison? Is it stuck in savings earning nothing? Is it stuck in IRAs and 401ks? Just talked to a lady earlier today where they've got almost $500,000, but then they're launching a new business. I was like, well, wait, we can get money out of the IRAs, use that money to seed the business, and you're writing it off, and you can cancel out the taxes. And then all the extra cash you have in savings, we invest that and get tax advantage returns like in syndications or other kinds of real estate. So yeah, we do more of the strategy and connecting. And that's a key thing. I mean, when we're looking at deals, like syndications, I'll tell you, I mean, I had somebody earlier today too, just say, I don't want to do, even if it's turnkey, where I'm not even managing the property and they won't even interrupt me on my holidays. I don't even want to have to think about having to deal with any issues that might come up for the property manager. Right. Well, great. Well, then we want to look at syndications, or, hard money lending, or dealing with, something else, like, stuff that's really passive. And that's the nice thing about syndications. I'll tell you, most of my clients, I mean, it depends on the client situation, because we look at, do they want growth or cash flow? Right. So if they want cash flow because they're trying to retire in the next year or so, the pref is everything to them, right? They want that preferred return. While the other ones are saying, I've got years, let's let this thing grow. Let's get that 18 to 22% IRR. Some of the syndicators we worked with, some of them have been caught on because they think, well, they're idiots. Why would they want to just take the pref? The growth is where the real money is. I'm like, yeah, but you don't get it. Like, they want that stable income. They'll take less. And so I had one syndicator, he actually said, all right, I'm going to create Class A, Class B shares. A shares, they get 11% pref, but no growth. That's it. They're basically just in debt. They're debtors, right? While the other group, they'll get, all the growth. It might be a couple years before you actually see a decent return, especially when we refi them out, the typical thing you'll hear. But, it'll be good. And so some of my clients will even say, cool, I'll take one of each. I'll get a little bit of the cash flow and I'll get growth. So then I get a little bit of both, like higher pref on part of my money and then a lower, really much lower pref and, more of a long-term growth strategy on the other. So it's kind of fun because everybody's different. Everybody has their own goals and their own objectives of what they want. But I mean, syndications is such a cool way to do it. Such an easy way to still get the tax benefits, but not be dealing with all the headaches.
Yeah, I've had a couple people that have done that with us where they're like, look, I don't really want to get like to the weeds on the deal or the equity. Like, can I just lend you money on like a promissory note or whatnot? And you guys just put it in whatever you want to, but then you just guarantee, whether it's personally guarantee or the group, the LLC guarantees it, but then they just want, like you said, they want the 10% return a month or a year, or they want, 15 or whatever the agreement is. They would just much rather have that. They don't care so much about the equity, but they are, they're, most of those folks are 60 years and older, and they got, like I said, they're more kind of, I wouldn't say wanting to play it safe, but like for me, I mean, I'm 40 years old. I've got more time to kind of be a little bit more risky or whatnot. But as there's different people have different things that they're kind of after. And like you said, I think that's great. I think it's great that people can go to your, like if they're like, hey, I want to get involved and I don't know what to do, they can contact you. And then through your website and through your programming, you can kind of like hear what their needs are and then kind of connect them to either the right sources of alternative investments.
Yeah, exactly. I mean, like I had somebody who's they heard me on kind of like a podcast or a webinar like this and was a syndicator. They'd already done several deals. They're like, yeah, but I want to diversify. Like, how do I do that? Because do I just buy stocks? I'm like, don't you dare buy stocks and don't just buy Bitcoin, just because that's what everybody else is doing, right? Like, yeah, you got to look at that and see what works and see what your objectives are. And you're right, everybody's different because, I mean, just today, two people I talked to that, again, they saw that Facebook post. They said, all right, I got to talk to you about, how we create this passive income. One had just sold his business. It sells next month. So he needs the passive income right now to just bridge the gap. He's still technically working in the business, but only part-time. So he needs that extra 70,000 a year to bridge that income gap, right? Another woman, she's like, I just sold my house. I'm single. I have no kids, no obligations. I want to basically be an expat. I want to go to Egypt next month. I want to go do this, 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 and this. I'm like, cool. Well, then let's do cash flow. As opposed to some other clients are saying, you know what? I already know I got to have this money grow for me. I'm going to need 5 to 10 years before I'm financially independent, which, by the way, is still pretty amazing. I always like the 1 year, 2 year type of financially independent cases. Those are always fun, but even 5 to 10 years, like, great. Well, you can be in the syndication for 6 years, double your money. That money comes back out. And then maybe that next play you do is going to be more of a cash flow play to then get that income that you need to finally hit it, because you'll be able to accumulate enough money to be able to create that much cash flow off the returns.
Yeah. No, it's great. And I think it's great that you have something, like I said, a platform where people can go and like, they may not know what to do, but they come across, your website and they're able to like connect with you and kind of, see what you do and how you do it and connect the dots. And then, obviously they're under no obligation to utilize to do anything with you. But the thing is that kind of like know who to point, who to connect them with. And that can always be sometimes such a hurdle, right? It is like us. I've got guys in this, like in Ohio, that when they go to retire and they've been in the drop program, which is the kind of like the, I don't know, in the fire service, you can retire like at 25 in Ohio, you can retire at 25 years and then you kind of like sign back on. And so on paper, you keep working, but you're not paying into the pension anymore like you had been for 25 years. And so when the guys get out, they can do, they used to be able to do anywhere between 3 and 8 years, but they get out and they just get this money handed to them. And for some of them, it's the largest amount of money that they've ever had in their, in one account before.
Yeah.
You know, I mean, you can be $500,000, $700,000, and it's like, what do I do with that? And so, you know, when we sit around the table at the station, it's always like, you know, that most of them are just going to whoever's managed their accounts for their whole career, and they're just giving them the money and trusting them to kind of put it where they need to.
Yeah.
And you said that those guys are making money off of the the assets they have under management. And so,
Mhm.
you know, you're a great alternative to that, where they can find you and or connect be I you know, I can connect them to you, and then you're able to kind of help explain and plug them into like the right players. And I think that's probably the biggest thing for me, is like making sure that people that I know get plugged in where they need to. So like maybe something that we're doing isn't what they want to do, but who do I send them to then they can also help connect them to the right place? Because ultimately that's what, you know, what we are about, is trying to get people in the right place and
Yeah.
get in the best situation.
Absolutely. Yeah, I mean, that's really the ideal, isn't it? That's what planning should really be. This is why I call it anti-financial advising, because, you know, what I learned as a financial advisor is that we're not financial experts, right? We
Mhm.
never were. We were just trained to sell specific products. We were really like the cook at a Mexican restaurant. You know, you're just like, hey, I just need to know what, you know, it's all the same ingredients. You know, I'm putting the same stuff in here. I'm putting in the rice and beans, meat, cheese, tomatoes, lettuce. You know, it's all the same stuff, just repackaged differently. You call a taco a burrito just because you either, you know, do this or you close it and it turns into a burrito, right? And
Mhm.
that's what financial advising is. It's really just mutual funds, insurance, right? And then the thing in the middle is annuities. Other than that, I mean, it's all just talk. It's just offering different variations of that same thing. I wasn't a financial expert. Heck, I didn't know how money even worked. You know, that's why it was such a big epiphany to me when I started to meet real estate investors and
Mhm.
seeing that whole alternative space. It was really like the Matrix. It was like I just took the freaking pill
Yes.
and I had no clue what was even available, because financial advisors aren't, especially if you're a securities license like I used to be until 2005. I couldn't even do investments outside of mutual funds. If I try to do do real estate deal,
Mhm.
I would have to clear it through the compliance department, who could easily reject it, say you can't put your money there, even if it's a good deal, even an investment real estate deal. So, you know, that's the problem, is that, you know, they force you to become a hammer and then everything looks like a nail. But when you move outside of that space, there's so much more freedom, there's so much more potential and real results. Because I can promise you, I've done the numbers. It's virtually impossible to become financially free using mutual funds. They don't return enough. There's not enough advantages, and you really don't have enough time for it to work. Even 401ks with a match, I've done the numbers, and when you factor in just a conservative rate of inflation, whatever you save into a 401k each year is what you'll be living on in retirement at that 3%.
Mhm.
So if you're saving the max $20,000 a year, or 20,500 or 21, right? If you're saving the max in your 401k, you're only gonna be able to pull out about 22, 23,000 a year. You're still in poverty, you know? So you have to like do all these other things. I mean, packing away, if you want 100 grand a year, you better start packing away 100 grand a year. And for a lot of people, that's just not possible.
Yeah, yeah, absolutely. And I think part of it too is that, like, you know, people are living longer, you know. I mean, as
Mhm.
medicine's gotten better, you know, it's, you know, maybe you know, I mean, you just look at even the retirement age, how it's just continued to go up and up and up.
Yeah.
And to kind of starve off on some of that, like, you know, it's like, if you retire, even if you retired at 67, but you live to be 97, you know, like, are you, who is, unless you're having some kind of passive cash flow or you've done very
Mhm.
well in investments up until that point, like, how do you survive without working? And that's what I always breaks my heart when I see, you know, the some older folks like working in like Walmart or Target or the grocery store,
Mhm.
they're doing these different jobs, is because they even at that age they still have to supplement their income,
Yep.
because they
Even with
can't
Social
live on,
Security.
they can't live on what it is anymore. And who
No.
knows if it'll be around when I get there, you know. That's the,
Yeah.
and that's where for me it's like I always want to bet on myself, you know. And so I know that if
Mhm.
what I'm doing or what I'm doing now is going to pay dividends years down the road. I mean, if not for me, for my wife or for my kids or whatever, you know. And so yeah, no, I think it's great. So how does, what it like, so what's it look like if somebody is watching this and they're like, hey, you know, I want to connect with you? Obviously they can go to your website. I
Mhm.
think I had it up on there earlier. Here, I'll put it back on in case somebody
Yeah,
wants
you
to.
had a
There you
moneyripples.com.
go. Yeah. So
Yep.
I mean, is that the best way for people to get a hold of you? I know, like, when we first connected, I had like watched some of the videos. I know you got stuff on YouTube, you get your own
Yeah.
podcast. Like, there's all kinds of different ways that people can kind of learn more about you and what you're doing prior to even calling you. And I think that
Mhm.
that's the great thing about like what we're doing today, what people doing podcasts or people doing different things, that they can kind of sit in the comfort of their vehicle or their own home and kind of get to know you and see like, is this really is this what's right for me? Is this really the route I want to go, before they ever have to just pick up the phone and call you or reach out via email.
Yeah, absolutely. I mean, yeah, definitely moneyripples.com's got a lot of information on there that we even have, even YouTube playlists based on the topic too. But I mean, YouTube, of course, we now are putting out about 2 videos a day, even if they're just little 30-second video, like video shorts, YouTube shorts and things like that. Even if you happen to use social media like Instagram or TikTok, we're even on there with @MoneyRipples. But I definitely recommend, if you want really go more in depth,
Mm-hmm.
follow our podcast, which you can find on YouTube or iTunes, which is called the Chris Miles Money Show. And we teach all kinds of topics on there.
Awesome. Awesome. Very good. So I would think, like, I guess like, the other question I would say is, how did you go? Like, what was the best strategy? I'm just curious on like how you went. So in 2006, you were doing real estate,
Mhm.
doing great. Sounds like you got really hammered by the recession. And
Yeah.
then how did you like, what did that look like for you to kind of get back out of that to where you could go financially independent again in 20, basically 10 years?
Mhm.
How did you do that? Was it, did you work and then reinvest, and then through reinvestments, like you made money back, and
Mhm.
what that kind of walk me through that?
Yeah, it was a long battle because I had over $1 million of debt to pay back. That was a big part. It was just paying it back. So I was working and doing my thing, and funny enough, I even stopped teaching people how to get out of the rat race during that time because I was in it. So I
Hmm.
started teaching people how to get resourceful, how to find money, how to free up resource, which is what I was doing exactly. So a lot of that is what I was doing. I was trying to get myself lean and mean, keep my expenses smaller, not to the point where you don't have a life.
Hmm.
I don't want you living on rice and beans, doing the good old Dave Ramsey method, where you're just going to be broke your whole life. But definitely being really a wise steward by tracking my money. So I was starting to really do that well, got my expenses down more. And then as I started to dig out of that hole, like I would pay off certain loans that had the biggest payment requirement compared to the balance. I pay the lowest balance with the highest payment ratio. I call it
Hmm.
cash flow index. In fact, I just did a video on it last week, in fact, or actually, no, this week. Just came out yesterday. But yeah, talking about the cash flow index and how to figure out which loans to pay off first. Then as I started to get back on my feet, then I was focused on other various things. So of course, taking profit from the company, that's the key thing is that entrepreneur, the trap that we get into is we reinvest in our business. And that's the easiest way to always stay broke, right? You can make millions of dollars. And I've met these guys. I mean, I'm in mastermind groups with other real estate investors that make multi-millions of dollars, but if their business shut down, and they can't flip properties anymore, they're just toast, right?
Yeah.
They can't do anything because there's a bigger rat race, just a bigger hamster wheel they're in.
Yeah.
So I was taking profit and saying, great, how can I use this to generate more income on the side outside of my business? And I was even doing stuff inside my business too. It was like, can I create residual income within the business as well with things that are like online or, recurring revenue type of streams that would also do it without me working? And what I found is as I did that, plus the investments too at the same time, that's where I got down to the point I was like, I had my podcast and I only coached a few people, but it was all gravy at that point. It was like I was working like 5 hours a week, and by the end of 2016 and debating about whether I was going to, fully retire. Am I going to retire the podcast? And, but the thing is, I love teaching. So I kept the podcast going,
Hmm.
but that's what I did as I just took, and any extra money I did have coming in, like from some of the clients, cool, reinvest that and use that to make it. And you kind of mentioned at the beginning, like almost like the income avalanche, right? Is that you take the cash flow you have, reinvest it to just keep that passive income growing each month, year, and so on. And that's really what it was. I mean, it's not really rocket science. It's just math to
Yeah.
some level,
Right. Well,
right?
yeah, it's true. Yeah, and that's something that like that I like to point out to people, or that I would point out right now, is that if it's in you to be successful like you were, you're going to
Mhm.
find a way. So like a lot of guys, I put myself in the room with that are real estate guys, whether they're that's something that we always talk about, was like, if I lost everything tomorrow,
Mhm.
I'm going to find it again, right? It's not like,
Yeah.
oh, I went bankrupt because something happened, or the market, the real estate market crashed or whatever, and you lose everything. Like, how are you gonna, like, what are you gonna do? You're just gonna fold up
Mhm.
and go back to working for somebody else, or
Mhm.
what's the plan? And almost all of them are always like, well, no, I would, I'm just gonna, what I did the first time led to success. Maybe they over leveraged and they learned this time not to do that, and so
That's
they
right.
go back again. But that's something that, like, I always, like, I talk to people about, is like, they're like, oh, I want to get into real estate. Well, I mean, you can get into real estate utilizing other people's money. Whether your first, a lot of people start off in single family homes, and so the first few that they buy, again, I think it's big time to get a mentor. So, right, if you want to get into real estate and you don't want to lose your shirt on the very first few deals, team
Mhm.
up with somebody else that's doing it, or pay for their time to learn what, like, that's what I did, right? I worked for a guy for a year almost, doing project management and then property management before I ever bought a rental property. And before that, I had educated myself for about a year and a half, 2 years before I, got in, because I knew that my first thing had to be a home run, or at least a base hit for it to be successful.
Yeah.
And that's something that you can do even now. Is like, you talked about hard money lending. You can get in a circle, whether you go to a real estate meetup, or somebody else that's doing it, or you're listening to this, or they go to your website and say, I want to get into real estate. I don't have the money to do it, but I've got the experience now. I'd like to,
Mhm.
get in and buy something. There's ways to do it where you don't have to, like, oh, I gotta go work 10 years to make this money to be able to go buy my first rental property. There's so
Right.
many ways that are out there to get into it. And once you get that ball rolling, it's so much easier to get the next one, and then the next one, and then the next one. And as long as you're doing it right and you have some guidance, I mean, there's no reason why in a few short years that your average person can't be financially free from real estate.
Yeah. Well, even like the BRRRR strategy, right? Where people can just buy their own home, rent out part of the unit or part of the place, depending on how it's set up, and
Mhm.
try to make profits there while you're building equity and very little down payment because you're getting an FHA loan at 3%. Yeah, there's just so many ways you can get started, and I think that's the key is just start the education process, start learning it. There's heck, I mean, there's even funds out there like I have a few that advertise my podcast. One of them is like a minimum of $100. you know,
Yeah.
you can if you got $100, great. You can put that into a real estate fund and make a little bit of cash in the meantime. Now, normally, if someone only has $100, I'm not going to tell them put it in that, right?
Yeah.
One thing I learned that was very valuable. It was interesting because my wife, she had pointed out to me. She's like, "Okay, you're paying off all this debt aggressively." She married me actually right when I was digging out of that hole, right when I wasn't quite financially independent yet. She saw me like, and she saw the debt too. She's like, "Oh my gosh, like that's huge." And I was like, "You should have seen it before. It was
Mhm.
over $1 million." But she was like, "Yeah, but how much do you have in savings?" I'm like, "Well, I got a little bit in my checking account, but once I get a little extra cash, I pay off a debt, all right, or I do this or do that." She's like, "Stop, like just you know, keep the money, sit on it." I'm like, "Can I do that?" Like, and I taught that before to my own clients, but then I was like, "Oh, I gotta sit on my money." Oh, and I noticed I was fidgety with it a little bit. I was like, "But I could increase my cash flow by using this money, like getting it
Yeah.
out there, doing stuff." The best thing I did was start to build that reserve because as I had that, there was no more of this worry of rubber band months, where it's like you're like, "Oh, I'm good. Oh crap, it's tight. What do I do to start hustling, get more money?" Once I
Mhm.
had that reserve in place, I relaxed, I thought more clearly, and the better opportunities showed up to where I was able to get out faster. Ironically, you'd think if you just keep deploying your cash, it's better. But if you've ever played the game Cash Flow, right, Kiyosaki's game, I
Yeah.
mean, the people that constantly always keep turning their money are gambling because all it takes is one little hit. You get laid off or whatever it takes, and the next thing you know, you're bankrupt. And it's hard to get bankrupt in that game. It's easier to go bankrupt in real life than in that game. So if you go bankrupt in the cash flow game, you kind of suck, like,
Yes.
and I've done it. I've done it in real life where I almost went bankrupt, but I should have gone bankrupt. And I've done it even in the game. Every time it's those fundamentals of hold on some cash, have a good reserve just in case, and then with the rest, invest it, increase cash flow by paying off loans or, freeing up on taxes, have a side business, side hustle that can give you some tax advantages too. I mean, there's so many different ways that you can improve your cash flow, even with little or no money, because I had to do it. I had to do it from nothing or heck, I was even $1 million more in debt than the homeless guy on the street. If you think about it,
Yeah. You're
he was $1 million richer than I was because he didn't have the debt. At least I did. So it's the thing is we all start from somewhere. We don't need money to make money, but really that value. How do you go out, show up, and provide more value, and how do you get creative and intuitive, really just using that ingenuity. That's the key.
Yeah, no, 100%. I couldn't say it better. So, well, I appreciate your time. As I said, we're hitting 40 minutes, so I want to be conscious of that. And if anybody's watching and they can agree with what Chris is saying, and they are, they've kind of been thinking about getting into alternative investments, but they really don't know who to call or what to kind of get into, check out his website and maybe connect with him on through that and see what he can connect you with. So let's see here. This is the great part about going live is you get phone calls in the middle of it. So anyways, all right. Well, Chris, have a great day. I appreciate your time. Hopefully you'll get some clients out of this and we'll get some people educated and people will, have some value. So,
hey, it was such a pleasure to be here. Appreciate the opportunity to teach and be able to share with you guys what I've learned, good and bad.
All right. Have a great day.
You too.
Thanks.